9 a.m. right here in Lagos, Nigeria. That means it's time for Business Morning on Channels Television. So get comfortable as we highlight economic conversations that concern you. I'm Ini John Mekwa. Well, let's start off with what the African Development Bank is saying. AFDB is calling for strong investment in young people on the continent. The AFDB president, Dr. Akinwumi Adesina, made this known at the ongoing 2022 Commonwealth Business Forum, which is going on in Rwanda. President Buhari is there. The forum is the first and largest in-person gathering for governments and businesses across the Commonwealth since the start of COVID-19 pandemic. According to Dr. Adesina, the future of the Commonwealth must be well shared across its 54-nation family, youth-driven and climate resilient, with equitable access to vaccines. Well, let's come to Nigeria now. Flight welfare package specially created by Anchor Insurance Company Limited is what is waiting for passengers on board a local flight in Nigeria. Let's find out how that works.
Domestic passengers within the departure hall of the local airport as they complete their boarding formalities. This group of passengers are target consumers of the latest products from Anchor Insurance Company Limited.
The main purpose of the local passengers flight welfare scheme, which essentially is in single product, is to meet all passengers' legal liabilities, compensate for losses encountered by passengers, including baggage delay, mishandled baggage, and loss of baggage.
The company believes this is a perfect opportunity to bring its well-known customer-centric finesse to bear in driving the product to real success and for the maximum benefits of its potential customers.
It's going to be attached to your payment, and it's usually 1,000. Then the loss of baggage delay, we have 25,000 that we pay for that. Then we have loss of baggage, 75,000.
There are benefits from this insurance product. This includes medical expenses of up to 50,000 naira for passengers who suffer any injury as a result of an accident while boarding or on board an aircraft. Children aged 0 to 3 years are covered by their parents' policy. Industry experts are optimistic this will be a game changer.
I believe in this product. At this period where a lot of people want to fly rather than travel by road in Nigeria, this product will do a lot of good to people who are traveling by air by taking care of the things that other insurances are not taking care of. You can trust Anchor Insurance when it comes to insurances.
I think it's quite affordable. It's a welfare scheme, and of course these benefits are additional to the limits that by regulation NCCA require all airline operators.
When all is done, an individual policy will terminate from the point the passenger collects or takes ease of luggage at the arrival hall of the destination airport.
Well, that's an indication that it's time to go into the commodities market, starting with oil prices. It fell today by 2% in early trade, extending losses from the previous day as investors worry that aggressive U.S. interest rate hikes could trigger recession and dent fuel demand. U.S. West Texas Intermediate crude futures fell by $2.39 to $103.80 a barrel, while Brent's crude futures dropped by $2.24 to $109.50 a barrel. Both benchmarks tumbled around 3% yesterday to hit their lowest levels since mid-May. Investors are continuing to assess how worried they need to be about central banks potentially pushing the world economy into recession as they attempt to curb inflation with interest rate increases. Well, we have Dumebi Oluwole now to help us understand, this talk of recession. Hi, Dumebi. Good morning.
Good morning, Ini.
So it seems we are talking more about recession now. How real or how close is this threat of recession?
I mean, the global economy has been all talks about it, and it's not like it's exactly what it is. The global economy is not yet in a recession, but the possibility of one happening anytime soon is what investors are weighing right now. It's what the markets are weighing. That's what economies are also weighing. And if we go back a bit, it's all stemming from the Russia and Ukraine war. Remember that the world hadn't completely healed from the COVID-19 pandemic before this happened. So we have inflationary pressures that are triggering a lot of triggering a lot of decisions from monetary policy authorities, and they're caught in the web of having to curb inflationary pressures and at the same time, be aggressive with interest rate hikes. Normally, interest rate hikes coming, gradually. So the markets are somewhat prepared. They know what is happening. They know by what percentage, and they're able to adjust. But right now, the U.S. Fed is being more aggressive, towards
and everybody's following
inflationary pressure. Exactly.
I wonder if MPC will hike the interest rate again.
I mean, it's not something that we can say categorically, but the world is tending towards that. And anecdotally, we've seen that when the global economy, moves towards a certain stance, here in Nigeria, we do the same, even though it does take a while. It does take a while, because when we saw that earlier in the year, when global economy started, increasing interest rates, we didn't do that immediately, but until May. And when we did in May, it was really high.
Aggressive.
Exactly.
150.
It was aggressive. So we might see them continue. We might see that trend continue, all in a bid to curb inflationary pressures. Right now, headline inflation is it's already 17.7%.
We're heading to 18.
And we're headed to 18. And
UK is heading
really
to double digits.
Exactly.
9.1.
Exactly. And the US as well.
US is 8.
About 8.6 or so, and now, and inflation is at for the US, the inflation right now is about a 41-year high. So, and all of this is coming from issues that have been triggered by the Russia and Ukraine war. The biggest issue of it all is the increase in energy prices and how different countries are just trying to manage.
Russia would tell you that it's not about their military operations in Ukraine, that it's the sanctions that the West is putting on them.
Because to them as the seller, I have what you need. You're the one saying you're not going to buy. So if anything, you're the one cutting yourself off what I'm willing to provide.
But even they are cutting off Germany even ahead of time, and a lot of countries, Finland and some other countries have already been cut off. Poland, even before the end of the year, which the EU.
Yes, and like what the EU did. No matter how much they're coming out to say, okay, they are sanctioning Russia and all that, because they still need the commodity. Remember that their 95% Russian oil ban is not until the year ends. So right now they're still demanding for Russian oil. So what they have done is cut off 75%. So meaning that some countries within the EU are still
Hungary is top on that list. They have categorically stated that they are not ready to win off.
Because it's going to have a huge dent on their economy. As much as the global economy is fast transitioning away from fossil fuels.
Did I hear you say transitioning?
Yes, I mean
Coal is back on the phone now.
That's where I was headed. That as much as we're hearing all of these talks. I mean, before the Russia and Ukraine war started, there were all talks about it. We heard some countries come out to say by 2030 they're planning to have all
even
electric
South Africa
vehicles.
tried it.
Yes, but with what the war has just clearly stated, that as much as we want to move towards that, fossil fuels are really not going anywhere anytime soon. Some countries have even reverted to the dirtiest of the dirtiest,
coal,
which is coal, just in a bit to keep their country powered up. So to tell you that we're highly dependent on this commodity. And that's why we see a lot of impact on several economies when oil prices swing. Either oil prices go either up or they come down. Now, and the truth of the matter is this, there are two stakeholders when it comes to all the oil markets right now. There are the oil exporting countries who are, you know, some actually who are raking in profits because oil prices are higher, and you have the oil importing countries that are highly affected because they have to satisfy their local demand, but yet prices are higher and they're having to spend more.
So, Nubemi, there's a question that has been on my mind, you know, when we're talking about inflation and the hike in interest rate. So, it does look like the inflation that the world is experiencing now has a whole lot to do with supply disruption.
Yes.
So I ask myself, is hiking interest rates really dealing with inflation, or are we just doing it because that's what textbooks say, that when inflation is, you know, surging, then interest rates should also be hiked to deal with it? Is it really what we need at this time? Is it really working?
So this is, the question you asked is a very fantastic one, I must add. But the truth is that it is very country specific. It is very country specific. Now, let me use Nigeria, and I would also use the US as an example. Nigeria, our issues with inflation are not only, they're mainly cost push induced. So we already had structural bottlenecks that were causing inflation to rise. And not until those issues are addressed, inflationary pressures will still be high. But the truth is that we can't also negate the fact that there are also, we're also importing some level of inflation that interest rates could, you know, provide some level of cushion for. So the increase in interest rates basically is just to tell investors, or please don't take your money out. We can still leave it here, because inflation, as much as when we go back to the basics of inflation 101, that's too much money chasing too few goods and an increase in general price, So when prices are high, we need to know what factors are causing the price to increase. And on that level, we already know that, okay, we have some lingering structural bottlenecks that are causing this, so we have to address that. But on the other hand, where we look at too much money chasing too few goods, we know that, oh, we need to retain some level of cash within the economy to make sure that this money is not going out, and that's where the increase in interest rates comes in. Because this increase in interest rates is not just off the books, right? MPR is an anchor rate. So when the MPR is increased, you see that the increase in treasury bills also increase. The interest rates, rather, on treasury bills are supposed to anecdotally increase. The interest rates on federal government bonds as well, just to make it more attractive, to reduce liquidity within the system. And then that would have an impact on, you know, money supply, and then have an impact on demand as well, and then have an impact on the inflation rate within the economy. So that's how that works. So when we look at the US as well, they are also having issues with energy-induced inflation, because inflation right now is not just, like I said, it's somewhat imported. You know, they are in the summer season, people are demanding for gasoline. Apart from that,
and they said they want to have that gas tax holiday.
Yes. So what we're seeing, that there's also the fact that, you know, rent is also going up, just somewhat like what is happening in Nigeria is almost happening there as well. And all of these things are somewhat imported because there's a shortfall in supply, like you rightly said. And because it is imported, like I explained before, they have to retain money within the economy. They have to retain money within the economy. And how do they do that? By making what the government is selling more attractive. And how do you do that? By increasing interest rates. So it will definitely take some time for the increase in interest rates to correct the increase in inflation. So the hike in interest rates might not somewhat curb inflationary pressures immediately, but it will soften the impact on people.
But it is why we are discussing recession now.
Yes.
Why recession is so imminent. There's also stagflation.
Yes, so there is that. Stagflation, very good point again. Stagflation has to do when, you know, when GDP is declining and inflation is increasing. So when you have that scenario, that's when you say an economy is experiencing stagflation. And that's what right now quite a number of countries are beginning to experience. And in a bid to reduce that, you know, that's where this same interest rate increase is coming in. But, you know, some countries as well are also trying to ramp up, you know, supply of their domestic money. And that's why we're seeing an increase in protectionist approach from some countries. For example, Indonesia banned, you know, its palm oil imports. Palm oil oil exports rather,
Yeah, even
so that
now,
they could satisfy
even now
local
that they
demand.
have removed the ban,
It.
the
The
policies
export
are
tax is
very,
still there.
yeah, very
It's still
strict.
there. And
So in quotes, they have unbanned it, but
yes,
I mean, in reality,
it's still expensive.
Exactly.
It's still expensive. And their situation was very unique. You know, remember I mentioned that there are two stakeholders when it comes to oil. It kind of plays out as well when it comes to what's happening with Indonesia. You see that because global prices are higher, exporters want to make a lot more money. They want to take advantage of that. So they hoard to the domestic economy and then, you know, try to export. So that export tax is, you know, trying to disincentivize them from doing that. But on a global scale, we see that several countries are beginning to adopt food protectionist approaches just in a bid to satisfy their local demand, tame domestic inflation, and increase supply. India has come out to say, oh, it's most likely would, you know, its sugar imports is going to, you know, curb it. We're seeing Malaysia as well has curbed its poultry exportation as well. So many countries are coming out to ration all of this.
Which one is Nigeria doing?
Nigeria is importing. Nigeria is importing. You know, we're highly dependent. We're highly import dependent, and the more these prices increase, the more we're exposed and vulnerable to external shocks.
And that's part of the reason why the World Bank is saying that Nigeria may lose 19 billion naira this year.
Yeah. And it's just, basically, we've seen the government come over time and time again. We've seen CBN intervention programs all in a bid to, you know, increase supply. But the main issue has always been when it comes to execution and monitoring, or to ensure that what has been said on paper is actually being executed. So until we're able to see these metrics actually, we'll say, oh, the Anchors Borage program has actually achieved this amount of increases and people can feel it. Until that trickle-down effect is felt, you know, we can't categorically say, okay, this has had a substantial impact on Nigeria. And we've seen the rice pyramid, we've heard something about groundnut, we've heard things about tomato, but we still import these commodities. We still import them, and that's because there is high demand for it, but supply is still
or supply chain disruption.
Yes.
Because, I mean, I spoke to someone in the agriculture sector, and he did say that there are stacks and stacks of corn, you know, in some store somewhere. Meanwhile, feed millers are not getting the commodity that they need. So where is the disconnect? I mean, I guess, as you said, it's beyond the policy and the paper and celebration on television.
Exactly. It goes beyond all of that, because as much as we are looking at how this would affect consumers, because that's the true way to tell whether a policy made at the top has been able to affect the life of people. So on an economic or on a development scale, when you look at growth, if you say the economy is growing, how well has this impacted the life of an individual in your economy? What is the GDP per capita of your country, or the individual rather? How much money can this person take to the market and say, oh, I earned this, the value of my money has actually increased, I can buy this amount? But inflation has completely eroded that. If you were earning 200,000 naira as of 2019 and you've continued to earn that till this year, the value of your income has declined by over 7%.
Yeah, you can say,
the real value
again.
The real value of your goods.
Petrol now officially being 165. But in reality, being
it's about like 300 now.
You know what I'm saying? And diesel is also another thing. And these are things that
people use on a daily basis.
Get on transport. I mean, even to get petrol, it's connected to diesel, because the operators in that line are saying, I mean, they use diesel to run their generators. They use diesel for the trucks that deliver it.
Exactly.
So, I mean, you cannot disconnect any of those things.
Exactly. So if all of the policies that we make are not yet trickling down to the masses, you can't say that these policies have been very effective. And when it comes to the increase, you know, the cost that people are bearing, people are paying more for transport, people are paying more for diesel, people are paying more for petrol, people are paying more for that. People's productivity is declining because traffic is increasing.
Yeah,
so
man hours
on the road. Exactly. So food prices are high. And remember that I mentioned that the issues affecting Nigeria's food supply or inflation is clearly, you know, they have been in existence even before the pandemic.
Before the war. Even before the pandemic,
before the war. So we were looking at issues, you know, from poor agric infrastructure, poor storage facilities, loss of raw materials or loss of these commodities. You produce a basket of tomato, almost half of it is lost, you know, because there's no
losses.
post-harvest losses and all of these issues. So until these issues are, you know, highly addressed, we'll continue to experience this these issues.
Well, this not a very beautiful picture for Nigeria, maybe, but it's our reality for now.
Yeah.
And we do hope we can talk ourselves and work it out.
Yes, hopefully.
Dumobiolu Wale, analyst with Financial Derivative, thank you so much.
Thank you. Thank you.
All right, so we'll take a break now. After that break, it's still Nigeria's economy we're looking at. We'll do a review of the first half of the economy and see if we can do a little bit of projection into the second half. Perhaps we'll have a brighter picture then. This is Business Morning on Channels Television. You're welcome back. Well, Sub-Saharan Africa currencies has had to deal with several negative forces in the first half of this year, from the Ukraine war, Ukraine-Russia war, to higher interest rates emerging from COVID-19, the U.S. ensuring risk-free sentiment. They also piled up their interest rates. Of course, that has to affect Sub-Saharan Africa. And then there's also net importers of petroleum products and countries heavily reliant on non-resident investment flows. Can it get better in the second half? I wonder. Ibuku Omoyeni is an economist with Vertifa Research, and he joins us now to share his perspective. How, Ibuku? Good morning.
Good morning, and thanks for having me.
Good to have you. Would it be safe to say it was a bloody first half of the year? Or we're still in June, or it's ending next week, though?
Definitely. Looking at the first half of the year, we've seen everything go bad, from worsening inflation to what we call the Fourth World War between Russia and Ukraine, and that has created a lot of risk around consumer prices, right? Even before now, we already had a problem of supply chain disruption. So the Ukraine-Russia war added its own pound of flesh to the challenges we had on ground. And of course, we are seeing inflation rise to levels we've not seen it before in several economies. We've also seen a lot of central banks pull back their policy support. And what we've seen is that when it comes to inflation, inflation could be demand pull, it could be cost push. And when you are trying to tackle demand pull inflation, you might end up hurting the economy, and that can lead to a recession. For instance, looking at the US, I just want to paint this scenario. The US inflation rate has been rising, but if you look at the core inflation, which excludes energy and food, since March, it has been declining. And that's because when you exclude food and energy, you see that there's depressed consumer wallet, and that shows you that a recession might happen in those advanced economies, while for other economies, there will be a definite slowdown in the economy.
When we talk about inflation, some economists have said that one of the feeding factors into inflation at this time is the COVID-19 packages, you know, that various governments brought out to buffer the impact. You know, that we're now seeing the release of such finances, and that's part of what is releasing funds into the system that is causing inflation. How true is that from your perspective?
Well, I would disagree slightly, and that's because what we saw in 2020 was that when there were stimulus measures, when there were quantitative easing, right, what we saw was that a lot of consumers piled those funds into assets. That's why you saw that risky assets started increasing from cryptocurrencies to equities. Stock market reached new highs during that pandemic, and that's because most of those funds went into investment. They did not necessarily go into buying more goods. Because once you're at home, you just need to eat what you need to eat, definitely. And you saw a rise in shares of, for example, Peloton, that specializes in working at home, like working out at home and all that. So we saw funds go majorly into the financial market. And that was why we saw asset prices go up. So the inflationary aspect of that pandemic was that supply chain was disrupted. Don't forget that for some months, we had lockdowns. And that disrupted a lot of things. And of course, when it comes to manufacturing, you have to plan your inventory, you have to plan all those things. So those lockdowns disrupted the plans that we had on ground. So inflation majorly is as a result of, first of all, the recovery.
So, don't you think, I mean, you did say that the funds went into investment,
yeah,
and now we see equities, markets are down, crypto is down. Don't you think investors are now pulling out those funds now, and that is also feeding into the inflationary trend that we see?
Okay, so the switch in investor sentiment from risk on to risk off was anticipating that the U.S. was going to increase interest rates and slow down its asset purchases. Now, I just want to explain quantitative easing here just a bit. Now, quantitative easing is different from ways and means advances, what we have in Nigeria. Now, quantitative easing is essentially the central bank, for example, buying treasury bills so as to keep the cost of raising funds low. So if, for example, a blue chip company wants to raise funds, it can do so at a cheaper rate. But if, for instance, the CBN did not decide to buy, that's just an example of what the US Fed is doing. If they decide not to buy those treasury bills, for example, the rate on instruments will go up, and that will make it more expensive to raise funds from the capital market. So what the US Fed did was to make it easy for companies to finance their activities despite the high-risk environment. But what we are seeing now is that because of the threats from inflation and the Russia-Ukraine war, the central banks are trying to pull out, although they've not done so as it was. For example, now, when Paul Volcker in the 70s wanted to address inflation, increase interest rate to double digits, not to curtail inflation. But currently, what we are saying is that the U.S. Fed is being careful so as not to strangulate growth. That's why you see that.
Doesn't sound like they're being careful.
They're being careful, sincerely. 25 bips, 50 bips, 75 bips. That's small compared to the kind of inflation we are seeing currently. And that's majorly because Nigeria it's not just demand pull, it's majorly cost push. It's majorly cost
Nigeria
push.
was not careful at the last MPC, or would you call that careful too?
I would like to say that looking at it historically, right, the interest rate we are seeing is not, the rate hikes we are seeing is not as aggressive as it was in those days, right? For example, during Paul Volcker's time in the 70s, interest rate went into double digits, right? Now we are seeing 25 bips hike, 50 bips hike, 75 bips hike. That's mild if you look at everything. It's actually very mild. Even in Africa, we have seen African economies increase it by a more aggressive amount. And of course, that's also because the US understands that in this time and season, once the US sneezes, the whole world catches a cold. So you cannot severely increase interest rates, especially because the financial market is more intertwined and there are other risks that are attached to the global environment currently. All
right, so looking at Nigeria's scenario now, the electoral activities started, but I believe they've not picked yet. After, all of the candidates and all that, then we expect major campaigning to start. How much of a disruption would you say political activities have brought to the economy or brought to the economy in the first half of the year?
I think the major disruption the election brought to the year was FX demand. What we saw is that since around the primaries, we've seen the Naira shoot up in the parallel market, and that has been a major disruption, right? But things still remain the same because we are still seeing the CBN trying to ensure that the priority sectors get FX. We've seen a couple of policies from the CBN to try and ensure that those sectors that need to get FX. But again, for the parallel market, you are seeing an increase in demand, and that's actually the major shock from the elections into the economy. But looking at the broader economy, we still see room for growth, and that's because it's very unlikely for the Naira to depreciate by a very large amount. Of course, there will be slight depreciations, but it won't be as large as it was in 2016, when we saw the Naira move from 199 to 360. We don't see that kind of risk happening now. If oil production improves, although we've seen some incidences of crude theft that has kept oil production below where it's meant to be. But once that risk is taken care of, you can easily ramp up production. And our estimate in-house at Vertiva is that when oil production rises to about 1.7 million barrels per day, we could see the CBN supply the market with more FX, and we could see rates appreciate in the parallel market. But that might not take place now because we are still seeing some bit of pressure on that FX side. And of course, that's how we see it for now.
Okay, so we do hope that we will see that increase in our oil production because, I think the last OPEC monthly report showed that we lost 195,000 barrels a day, and then our production has gone down to just over 1 million, which is supposed to be 1.7. That's the quota that has been given to us. Well, looking at away from oil now, the agriculture sector, and then the issue of border closing. In this first half also, the border that has been closed, for a couple of years, was reopened. Did we feel any difference in that?
Okay, interestingly, in our report, we actually have a chart that shows the map of Nigeria and states where those borders were opened. But what we've discovered is that because since the federal government introduced that ban in 2019, a lot of informal traders had to leave the area. And most of our trade is currently being formalized. So there's no informality. You could just easily go to Benin Republic, for example, buy some goods, bring it into Nigeria and sell. So you don't have that increase in supply anymore. That's why you are not seeing the impact on food prices. We saw that when just a report by FX, of course, showed that when the borders were opened, you saw that there was some the price of grains actually reduced a bit, but the pressure came again because of course, the supply chain disruptions. You already have, there's already a broad-based food challenge, even across the world. So, of course, that's why you're still seeing food prices and prices of food increase. But in the near to medium term, if Russia-Ukraine war persists, we could keep seeing the pressures from the energy sector feed into consumer prices.
But can we count some gains from that closure of the border?
Gains on the closure of the border, it may be difficult to assess from an inflation standpoint because ever since the border was closed, inflation has remained above 11%, and it has stayed because we've had additional pressures. Border closure in August 2019, to COVID in January or February 2020, to we saw rounds of depreciation from March to June to July. In 2021, of course, we saw some moderation, but by the end of 2021, we saw energy pressures pick up again from where border closure and COVID-19 stopped. And now what we are seeing currently is fuel scarcity driving inflation further. We didn't expect it to last this long, but the resurgence of fuel scarcity is a key risk in our views. And that's why we expect inflation to be at around 70.5% in 2022. What we've discovered historically is that in pre-election years, inflation declines. This didn't happen in 2010, but every pre-election year, there's meant to be a soothing impact on inflation. But because of this risk, it's possible that inflation would actually remain above 2021 levels in 2022.
Just before we let you go, the NBS has announced plans to rebase the nation's account statistics for CPI, Consumer Price Index, and GDP. And, well, I think one of the first things that comes to my mind is a lot of Nigerians actually ask when we say, oh, there's inflation figure, we talk about GDP. They ask how real this is. And I think this boils down to the basket of commodities that is used to measure both inflation, GDP, and all that. Would this be what the NBS is trying to address?
Essentially, rebasing is just majorly changing the base year because with the base year we currently use is 2010, but things have changed since 2010. So you want to include some other commodities that we consume more during this time. So if you break a recent base year, let's say 2019, you can have a clearer understanding of inflation. You can be able to measure it. For example, if you notice, for the past 3 months, people are saying inflation numbers is not real. But those numbers are real because the base year that is being used is what makes it look as if it's not so real. But by the time you rebase, you tend to see a sharper increase. For example, in Ghana, the inflation is almost around 20%. It's not as high as it is in Nigeria. So once you rebase, you tend to have more reflective numbers. That would help you to calculate your adjusted returns.
All right, so we do hope that they do that rebasing, and then we so by the time, you know, we're in the media, when you're doing a report or you talk about a figure, people are like, oh, please, it doesn't mean anything, or it does not capture the reality. So it would be really nice to have a basket of commodities or base here that actually captures the reality of today, and people will appreciate. And I guess that would be a better way to plan anyway and project.
It's true.
Thank you so much, Ibukun, for joining us this morning. Ibukun Omoyeni is economist with Vertical Research. Enjoy the rest of your day.
Thank you.
Let's look at the markets now and see how it went. Well, I think it's good news sustained in the local bourse here in Nigeria. Positive momentum from yesterday. The Osha index advanced 0.6%, continuing the same trend the day before. And now the Osha index has gone back to that 51,000 points. And performance gains from Dangote Cement and Boer Foods drove that positive sentiment that we see there. A month-to-date loss moderated to -3%, while the year-to-date returns increased to 20.3. And there we see the sectoral performance. Consumer goods was the only green light there. Every other one, the banking, back to that fall. But I mean, it's been positive for a couple of days, I think 2-3 days. So industrial goods in the red, insurance in the red, oil and gas also in the red. We have joining us now, Falabi Benro, joining us virtually to tell us some of the driving factors in the markets now. Good morning, Falabi Benro.
Good morning. Thank you for having me.
Good to have you. So we've seen 2 positive trading days now. Is this the norm? Should we hold our breath? Or should we just get into the waters, as somebody said, with our toes?
Yeah, so the market has basically been driven by sentiments over the past couple of days. So we've seen positive sentiments driving the market over the past couple of days. If you remember the MPC announcement that indicated a 150 basis points hike, for us in the equities market, we have been expecting a flight away from equities in towards fixed income. And in some cases, we've been seeing that. So we're happy to see some of the gains that we've been seeing over the past couple of days being sustained by positive sentiments.
So we expect this to be sustained, but there's also the anticipation for the earnings. That should also bring more positive sentiment, I guess.
Yes, I mean, typically corporate earnings seasons is something that is a catalyst for the market. So yes, we would say that with that being in mind, that investors will possibly be taking positions, ahead of that. Also to flag that, we're also just coming out of the corporate earnings seasons where dividends and bonuses have been declared. In some cases, we've seen some of this cash being reinvested back into the market. That could also attribute to some of the gains that we have seen over the past couple of days. So it's possible that we'll continue to see that going forward until the cash is utilized.
But when we look closely at the yesterday's trading, we see that there seems to be still a whole lot of profit taking still going on. So the market is still at risk of tipping back into the negative territory.
Yes, I mean, profit taking is definitely expected. Bearish sentiments have been in the market, especially in the banking names. If you look at the likes of GTCO, Zenith Bank, MTN, we've seen profit taking continue in the market in those names. It's likely that it would continue. But also on the back of that, we're also still seeing buyers come in. So you have to wait and look at it and say that, at the end of the day, at what point would the price get low enough for it to start being attractive for investors to start coming in again? And I think we're getting very close to those levels.
All right. So how do you see the market closing today?
So similar to what we've been seeing over the past couple of days, it's probably going to be slightly up from the indications that we're seeing. Like I mentioned, we've seen bearish sentiments in the likes of GTCO, Zenith, and some of the other banks. We expect that to continue today. Positive sentiments across some of the other sectors.
All right, Afolabi Benro, trader with Stanbic IBT Stockbrokers. Thank you so much for sharing your thoughts with us.
Thank you for having me.
We'll take a break now. When we come back, we'll head to London. This is Business Morning on Channels Television.
Like drops of rain, individuals and groups innovate, birthing ideas that might make the difference in the conversations and action to fight climate change and the negative impact of man's activities. Innovative thinking from Africa and Europe to save our planet, to light up our cities without tearing apart the ozone, making progress safe and sustainable. On Eco Africa, we highlight the efforts to live and grow sustainably at these times on Channels Television.
Tune in to Gist Nigeria and get the lowdown on the issues that really matter.
You have the world at your fingertips.
check out the Nigerians shaping the future at home and around the world.
What inspired the film was my life story.
And hear from those voices without a platform.
That I lost my brother.
This is your country.
Anything you set your mind to, you can bring to life.
This is Just Nigeria, a partnership between the BBC and Channels TV every Wednesday at 9 p.m.
Welcome back. Head to London now, and it's interesting to know that when we talk of debt and debt servicing, it's not just about Nigeria. And the UK government borrowed more than expected to balance the books last month. Well, we have Juliana joining us now. Good morning, Juliana. What was the bulk of this used for?
Good morning, Annie. Well, the bulk of it has actually come from servicing debt, because we know that the midst of the pandemic, expenditure, paying for the furlough scheme, guaranteeing all of those loans has come to an end. So the government is actually borrowing much less, but because of the high levels of inflation, currently at 9.1%, it's the debt servicing that has cost the government so much. So the figure came in from the Office for National Statistics for the month of May, borrowing at £14 billion, but only £7 billion was borrowing. Double that was because of inflation. Now, the inflation that we talk about is the CPI, which is the Consumer Price Index. Government debt is actually measured by the Retail Price Index, which is even way more higher than the 9.1%. I believe it's about 11.5%. So I think for the Chancellor, it's really not much to see here. He thinks it's just that we're going through this pretty sticky period, and we hope to get out from it sometime soon. The problem is, of course, debt is going to significantly increase over the next couple of months, because last month the government put, I believe, about £16 billion of public money into helping vulnerable households, the 8 million households that will be receiving that £650. Some, if you fall into the mobility issue, or if you're an elderly person struggling to pay your bills, you could be getting up to £1,250. That's costing the government £16 billion. So I think when it comes to June and July, that's when we're going to have a look at this ONS data, and we'll be even more alarmed than the one we received from this morning.
Yeah, which is why, Juliana, with just 100 days left for everyone to dispose of their paper, 20 and 50 pounds notes, how seriously are people taking that when you have the rail strike to deal with, you have inflation, you know, you have petrol prices, gas prices? I mean, are people really looking this way?
Well, this is just an announcement, Innie. It's something, I think, if you're living in the UK and you use cash, most people don't really use cash anymore. I think this is probably an announcement from anybody who's wealthy coming in from Nigeria or anyone else, anywhere else abroad, that likes to hoard a lot of cash on them and thinks they can spend it anyhow they can. You can't anymore. The Bank of England have released an announcement saying that the old £50 and £20 paper note will become illegal tender by the 30th of September. So you have 100 days from today. And it's funny because, of course, you would expect that because of the pandemic, most people are using contactless payment methods here in the UK. But according to the announcement, there are about £6 billion worth of these old paper £20 notes in circulation, and £8 billion worth of old £50 paper notes in circulation. So I'm sure if they're under your bed, you just need to make sure you take it out, or if it's in your wallet. If you're lucky enough to have a stash of £50 notes somewhere, please do go and change it. They've been changed to polymer. We've been using this polymer paper, I think, since about 2017. Started off with the £5 note, then the £10. Then, of course, in 2020, February, we had the change of the £20 note. And then last year, we had the £50 note. So I think the vast majority of people in the UK have already switched over. But if you have any left, you've got 100 days until that becomes, no longer of use. So anybody watching in Nigeria that's got loads of cash stuck under their bed, yes, it's definitely time to spend it.
I'm just going to go and check under my pillow. You just told me something I think I forgot, so I have to check that out and probably send it to you to help me.
I'll use it for you, Innie. Yeah.
All right, Juliana, thank you so much. Talk to you at 1:30.
Thank you. Okay.
Let's go to the crypto space now, where Ladi is standing by. Hi, Ladi.
Hi, Innie. Well, maybe you might even have some Bitcoin under the pillow. Who knows? But it's extreme fear right now we're still seeing, in this market, still at 11 points over 100. Sentiment is still, gearing towards the bears, but at the end of the day, we're seeing a little rebound in the market, some relief rallies, even though global equities market are not looking so good at this time, but we're seeing some relief happening right in the crypto market. We're seeing the market cap, $900 billion. That's up by 1.10%, and we see volume traded down 4.89%. Bitcoin dominance, 43.05. And see the price of Bitcoin there ranging between the 21,000 and 19,800 range this morning. It's up 2.20%. We're seeing a couple of altcoins also rebound this morning, but there's still risk of downside price action for Bitcoin. That's what most analysts are saying. Doesn't seem it's out of the woods yet. Volume traded $29.10 billion, and we see Ethereum there also struggling to hold that $1,000 mark. It's up 1.65%, $1,096 per coin. Volume traded $15.04 billion. We see it's mostly green on the top alts by market cap, and a lot of trading and shorting going on in this market. Now, let's bring in Amari Sachet now, eCash creator, join us right here on the show. Great to have you.
Hey, great to be here.
Yeah, so Amari, talking about shorting, these markets, now we've seen the shorters have been having fun since Bitcoin fell from around the $30,000 range all the way to about $17,000. And we're seeing ProShares, ETF giants, looking at creating a short ETF for some of these investors so that they can bet on when Bitcoin is going to go down or go up. How are you seeing this development?
Well, it's not really going to help price stability, that's for sure. But on the other hand, that's probably the beginning of some sign that we may be near the bottom, right? Because if shorting is starting to become mainstream, then that means that a lot of people have shorting in their mind as the option for crypto, and so that means that most people expect it to go down. Usually, that's a sign that you are near the bottom. Same way as when we were near the top, like roughly a year ago, everybody was super enthusiastic about any and every project. So be fearful when others are greedy, and be greedy when others are fearful. So it's an indicator that people are fearful, and therefore there is probably a time to start being greedy. I'd still be cautious, though. There are still some projects that look a bit shaky that may still bring the space down a bit, like USDD being one of them. It's been depegged for, like 2 weeks now and holding at 0.92, something like that. So that's a bit scary. We don't quite know what's going to happen with that. But, we will see a couple of projects fall, but those kind of stuff kind of indicate to me that, probably the bottom is going to be somewhere in the summer.
Yeah, it'll be quite interesting to find, that bottom. Every trader is looking for the bottom, even in global equities market. But, with this ETF, coming out in the U.S., do you think traders are going to buy into it at this point?
It's difficult to say. Clearly, ETF appeals to more traditional investor more than crypto people, and how much those investors are interested to have some exposure to crypto remains to be seen, especially right now when the market is very low. People are probably gonna want to keep some distances with it, but we'll see.
Yeah, we'll see. Looking at Bitcoin now, we're seeing the price is struggling at this point, trying to stay above that $20,000 mark, and it did touch 17,000. There's a lot of speculation here, for the bottom, but what price is looking attractive to you?
So, right now, to me, I don't know if it's the bottom or not, but right now, to me, the price of, many assets looks already attractive because we're in the bear market. It's very, very difficult to time the bottom. I know that some people want to do that, but, unless you're an expert, I would advise against doing that. And I would advise to go with a strategy that is more on dollar cost averaging, where you buy at several points in time and you won't get the best price, but you won't get the worst price. You would get like an average price, hence the name. And as to what asset you should be looking into, you should look at assets that have strong fundamentals, that have an actual use cases. All the assets that, like, look at how people are selling you the asset. If people are telling you, oh, you should buy this asset because it's going to go up in value so much, it's probably a bad bet, because what they're selling you is it going up in value. But if they were convinced that it was the case, they wouldn't be selling that to you. They would be keeping it. So that's probably a bad bet. However, projects that are like, oh, this is useful because we are building this and this and that, and we expect, that to generate demand, then those are probably good bet for the next 2 years or so.
Right, for the next 2 years. All right, but let's look at XEC. Now, we know that, Avalanche integration, that conversation has been going on for a while now. How's it looking?
It's looking pretty good. So right now, all the clients that people can download and run are compatible with Avalanche. It hasn't activated on mainnet yet, and there are a few reasons for that. There are a few edge cases that are running out, but it's looking pretty good. And the bear market is when the building happens. So right. I would invite people to look at those teams that are building during the bear market and go with that. During the bull market, everybody is going crazy, but the real building happen with the bear market, and this is what gets built during the bear market that triggers eventually the next bull market.
Building in the bear market. Thank you so much, Maurice Sachet, ECAS.
Thank you.
It was great having you. All right, now let's look at the top also market cap. We've seen BNB there, $223. Seen bounces across board in the crypto space. XRP still that 32 cents range, up 2.46%. And look at the top 5 gainers there. We've seen double-digit gains this morning with Matic there, 50 cents, up 26.48%. And Engine, Sandbox. We're seeing most of these metaverse platforms getting into the top gainers counter. Engine there, 51 cents, up 15%. Sandbox is 97 cents, trying to get above that dollar mark. And we see Flow there, $1.57, up about 10.96%. And top 5 losers, seeing more single-digit losses this morning. This one had a run, Synthetics there, had a run recently, went up about 80%. We've seen a couple of profit-taking there. It's down 8.28% this morning. Waves platform there, $6.36, down 3.84%. And we see BitTorrent there, less than a cent there, down 1.08%. But we're not seeing stable coins on this counter. So it shows that traders are still have some skin in that market and trying to look for some fundamentally sound cryptos at this point and trying to get back in there and see if they can make some gains. So it's not looking so bad this morning, but we know we still have Friday, tomorrow. We know how Fridays...
normally a red Friday.
Yeah, we know how Fridays normally go, but who knows? We might see a switch tomorrow.
Let's watch tonight, midnight, and see what will happen.
Exactly.
Thank you so much, Ladi.
Thank you.
Well, that's it on the program today. Thank you so much for being a part of it. It's been fun and very informative. Let's do it again tomorrow. I'm Ini John Mekwa, but at 1:30, Business Incorporated will be here and we'll give you updates from the world of business.